Meta is one of the world's biggest tech companies, and it just went a huge restructuring on all its different departments. Right now, it's driving analysts crazy, receiving 37 ratings, with 36 of them being a strong buy. They indicate that the average price target should be around 390, which indicates a pretty big increase in price from where it's sitting at right now. And the truth is that this company has insane future prospects for growth, and it is a great company that has recently improved its margins thanks to its restructuring, and it has great cash flow generation. So this, of course, is the famous Meta, which used to be Facebook, and they are combining metaverse and AI into their offering as we speak. So in their annual report, they say that they aim to give people the power to build community and to bring the world closer together. The company itself is divided into two segments: the family of apps, which is the part of the segment that actually generates cash flows and brings in all the revenue and the net income for the company. And then they have the reality labs, which is the part where they are experimenting with the metaverse, with augmented reality, and even with AI. They have some things that they have been developed recently in the reality labs. The first one being the Meta Quest, which is the virtual reality devices that right now they are selling to the public. They also have the Ray-Ban Stories, which are the smart glasses where you can use all the different apparatus without using your hands, and you can be online basically as if they were a virtual reality glasses, but they are cooler since they are Ray-Bans. And you also have the Meta Spark, which is a program that facilitates the creation of VR and AR experiences for different people. So if you would want to create an experience in VR, you would probably use Metaspark, as it has a lot of tools that could help you out. This company strongly believes that the metaverse will become the next computing platform and the future of social interaction. So let's see how they perform in financial metrics. So right now they are sitting at a 16% return on capital employed, which is a pretty good number. I believe that this year has even improved further. This is a number that you want to generally see at 10%, and the higher it is, the better. In terms of interest cover, they have basically no liability risk, as they can pay out their interest 180 times with their current EBITDA. And in terms of cash conversion, they are insane at creating free cash flow, as they generate, this is the percentage of free cash flow that they create with the income they generate. And in terms of margins, they are insane. They had an 80% profit margin, and now they have a 25% operating margin, which I believe has improved due to their restructuring. Here we can see the restructuring, and we can see the expenses as a percentage of revenue. From the third quarter of 2021 to the third quarter of 2022, visually, it is very simple to see how these costs have been increasing. But since then, up until now, you can see that the restructuring that this company has undergone has been brilliant. Not only improving their margins, but also driving their free cash flows to the ceiling and their net income increasing by around 50%, even as their revenues stayed stable or even fell a little bit. Here you can see the net income I was speaking about. It is a complete change in the mentality of the company. They woke up, since they were being a bit troubled, their stock was being a bit troubled, and they decided to take the right actions, and boy, has it been paying off. So in terms of fundamental analysis, there are many things I like about this company, but there are other things that I'm not so sure about. So I'm giving them a 5 out of 8. Of course, they have incredibly low liability risk, which I would consider basically zero, and they have a very solid balance sheet. Additionally, they have an existing moat with a strong competitive advantage, since we're not going to kid ourselves, basically the whole world is addicted to either Instagram or Facebook. The only one that could take their competitive advantage away is TikTok, but that is already priced into the stock, I believe. They are great at doing organic free cash flow growth, as we have seen the restructuring has increased their free cash flow even as the revenues have not increased. But here is where I see the problems. First of all, their cash flow is not consistent because they are investing heavily into their reality labs, into the metaverse, and into projects that are not profitable, and I do not see them as being necessary right now. They are currently shifting their investments from metaverse and incorporating a bit of it into AI, but I believe that they are late and they would have a lot of ground to make up in order to chase the other players in this area. From here, they also have a lack of organic revenue growth and they are conducting small share buybacks. So they are reinvesting the majority of cash they generate. The thing is, I am not extremely sure whether this cash investment will pay off in the future. But of course, I'm not a tech genius. Mark Zuckerberg is, so I could be wrong, and some of you may have a different belief to this than I do. In terms of long-term analysis, I believe they do have extremely growth potential. I believe the company has incredible people working in it, has an incredible product, and has great vision for its future. Additionally, it's following secular trends as it is heavily investing in AR, VR, and AI. And they have two main avenues, as always. They have the existing offering improvements, which would be improving the way that revenues are generated through Instagram, through Facebook, through Messenger, or even through WhatsApp, just improving the way that they are able to generate those advertising revenues. And also on the other avenue, they have the AI, AR, and VR innovations, and hopefully these will pay out for the company. If they do, this will be a killer company with incredible returns. In terms of valuation, I believe it's not cheap right now. It used to be extremely cheap before they did the restructuring in June, September 2022. As you can see in the graph, it used to trade at around 13-14 PE ratio, and it is now back to where it belongs at 28 PE ratio. In terms of free cash flow yield, I think it's a bit expensive and not an attractive valuation, at least for me. They are trading at a 2.47 free cash flow yield, which is lower than the long-term inflation rate of 3%. I believe it's trading at a bit of a premium, and this is reasonable, of course, because this company is extremely high quality company. It's one of the Magnificent Seven. It provides incredibly consistent free cash flows, and of course, all investments want to own it, just in case the long shot investments into AR, VR, and AI pay off. In terms of risks and possible challenges, I think they are heavily affected by a worsening competitive landscape, not only by TikTok. I believe that in the businesses they are investing, AR, VR, and AI, they are basically the biggest industries right now, and the ones with the most amount of, or with the highest number of competitors in them. In terms of regulatory, I think they will be affected by regulatory changes in terms of helping people to get off their phones, or not even that, just regulating the VR conditions, regulating the AI industry and all that. They are very tech heavy, regulated heavy industries, the ones that they are operating in. But I don't believe regulations will be bad for them. I just put 70% to be conservative and saying that we should take this into account. In terms of performance, I do believe this is the highest risk and possible challenge, and it is mainly because they are investing way too heavily into their Reality Labs section. I would really like to see this company use their cash flows also to reward the shareholders, either by dividends or by share buybacks. And finally, in terms of market, I put a 60%, which is the same as I put for Google and Alphabet. And this is because their main revenues derive from the same thing, which is advertising. And in case of an economic downturn, advertisers usually cut back on their spending. So this could be a possible risk for them. And as always, these are very conservative. I like to be conservative on my investment thesis. Before we move on to the investment conclusion, please remember I'm not a financial advisor, and this is not financial advice. Please conduct your own due diligence before buying the stock. In terms of moat, I think it has a strong competitive advantage. I do think so. I think they have high return on capital employed, which is great because it creates value for the investor. And the tricky one is the consistent cash flows, because although they do have consistent cash flows with predictability and resilience, I'm not that sure that they are that predictable, since to me, it doesn't seem like they have a strong future strategy in place. I feel like they invest into their Reality Labs whenever they want, and they don't have a fixed goal in mind. They're just investing to see if something works out. But I do believe that it's a great company, and it will be a great investment with high returns. So thank you for watching. As always, this has been the Cashflow Compounder. Please join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trader Republic.